I'm Greg Bangs of Booz Allen Hamilton, and it's my pleasure to welcome you to this panel. Is the financial crisis really over? Well, given the events of the last few weeks, I'm sure all of us would like to hear where our esteemed panelists think the economic situation is heading. Our moderator, Lloyd Howell, is a Booz Allen Hamilton Executive Vice President responsible for the firm's finance business. He leads services involving innovative approaches to some of his clients' most challenging problems, from bank receivership to cash and payment channel modernization, to cybersecurity and fraud detection. Lloyd also serves on the boards of the Children's National Medical Center and the United Negro College Fund. It's my pleasure to introduce my colleague, Lloyd Howell. Lloyd?
Thank you, Greg. Today's topic, as I'm sure we're all aware of, is very important to us. And I am joined this morning by three panelists that I'm sure you will enjoy hearing their views on this topic. To your far left, we have David Stockman, former director of O&B under the Ronald Reagan administration. After leaving government, David joined Salomon Brothers, later became a founding partner at the private equity firm Blackstone Group, and founded Heartland Industrial Partners. Next, we have Roger Ferguson, as the president and CEO of Tiaa and a member of President Obama's Economic Recovery Advisory Board. Previously, he was head of financial services for Swiss Re, vice chairman of the Board of Governors of the U.S. Federal Reserve System, a voting member of the Federal Open Market Committee, and chairman of the Financial Stability Forum. And then next we have Christopher Hyzy, is a managing director and chief investment officer at U.S. Trust, Bank of America Private Wealth Management. In this role, he oversees the investment solutions and the end-to-end investment process, including portfolio management and investment strategy. During our discussion this morning, we'll explore ways to drive innovation, spur investment, bolster confidence, and restore the integrity and transparency of our global markets. There are a range of difficult choices facing economic policymakers and leaders of financial institutions as they grapple with the fundamental high unemployment, which we heard in the previous session, stagnant real wages, and historically high deficits. Today, as we consider whether we are out of the woods or not, our panelists will have a lively debate. In fact, given the debate started last night over drinks, this morning at breakfast, I'm sure you all will enjoy it. We'll cover the social, policy, structural steps that must be taken to bolster the recovery. As we dive into this subject, I'd like to ask each of our panelists to share their views before we get into it. Roger, let's begin with you.
Okay. Thank you very much, and I hope all of you can hear me. The question before the panel is, are we out of the woods yet? And the answer to that question depends on how you define the woods. So if you thought the woods were a deep recession going into a global depression, the answer is we are not in those woods, as far as I can tell. In fact, I put a very low probability on the famous double dip that many people worry about. So which woods are we in? We are still, I believe, in the woods of a very slow, uneven, volatile recovery that is also leading to a great deal of volatility in markets. Why is that the case? Well, because we have a recession, or had a recession, that started with balance sheets of both banks and individual households. Those types of recessions, and we've had several of them in the global economy, have always tended to end and then have a very, very gradual recovery as individuals and banks decide that they must rebuild their balance sheets. In those circumstances, banks are reluctant to lend. Frankly, many individuals and businesses are reluctant to borrow. There's a high degree of risk aversion and a general focus in on risk-free assets. And we see that to be pretty much the case now. So that's where I believe we are. I think it's going to take some time for this recovery to really get real traction. And we should all be expecting from month to month, quarter to quarter, some positive news and some negative news, but broadly on a gradual but volatile upswing. Broader than that question, though, is the bigger woods that we're in. So we will get out of this recession. We will see continued gradual improvement, but it leads to a place where we've got a number of broader structural issues to worry about. Global imbalances, debt and deficit, and one that I'd like to add, which is demographics. the aging of the global population, US, China, Western Europe, et cetera, is putting a great deal of pressure in the US, or will put a great deal of pressure in the US on things such as Social Security and Medicare. And then, as I'm sure some of the panelists will talk about, once we get through all of this, the US and much of Europe will be saddled with, for our economies, relatively large amounts of debt, and if we aren't careful, a need to really understand how to manage ongoing deficit spending. And so we're out of some woods, to summarize what I've said, in that I don't fear at this stage a double dip. We are still in the woods of a relatively slow, uneven, and volatile turnaround, and that little patch of the woods is in a much bigger context of global imbalances, deficit, and demographics.
Thank you, Roger. David?
Well, Lloyd said that I'm on your far left. Actually, I'm on my far right. But I'm not really coming at this from the right side. I'm coming at this from the dark side. Because I think if you look at the bigger woods that Roger's talking about, we got a horrendous problem called unsustainable debt. So I don't believe that we're in a normal business cycle and now we're in the rebound. In a year or two we'll be out of it and we're going to have a V-shaped or a U-shaped or a W-shaped recovery. I don't think any of those alphabet soup really matter. What I think is we got off track drastically in 1980. We've had a 30-year spree of money printing and debt accumulation that is off the charts by any kind of historical standards. And as a result of that, we're going to struggle with a debt deflation for years and years, maybe even a decade. We'll talk about this more, but I'll just give you the number and the framework that I'm starting from. In 1980, when all this began, we had $3 trillion of GDP in our economy and $5 trillion of total debt, public, private, household, business, added all together. So the debt ratio, or let's just call it the leverage ratio on national income or the national economy, was 170%, 5 billion to 3 billion, 1.7 times. Now, it's very interesting that that is not just a random number from 1980, but it actually represents what I call the golden constant. Because the truth of the matter is you can go back 110 years into history, back to 1870. We're barely out of the Civil War, and you will find that the debt to GDP ratio in our economy was 1.7 without fail, only minor fluctuations up and down in war and peace and boom and bust, even excepting a couple years in the 1930s. So what happened during that 110-year period? Some pretty good things. Our economy grew a lot, our wealth increased, our productivity expanded, we became the greatest economic power on the earth. What happened after 1980 is that we lost the golden constant and our debt accumulation began to go literally straight up or parabolic. By 1990, we were at 2 times. By the late 90s, 2.5 times debt to GDP. By the mid-2000s, we were at 3. By 2008, when the crash came, we were at 3.7 times. Now, you can say, well, these are a lot of interesting numbers, statistics. What's the difference between 3.7 time leverage ratio on the total economy, private and public debt, and 1.7? I'll tell you, it's a startling number. Had we stayed on the golden constant after 1980 and not printed all this money, not had this huge housing ATM machine borrowing binge and spending spree that we had, we would have had $23 trillion of debt, public and private, in this economy. That's the golden constant, 1.7 times, because our GDP then and now is 14 trillion. But as a result of the spree we went on, and at 3.7 times, not 1.7, we had 53 trillion of public and private debt in 2008, and we still have it. So there's an incremental 30 trillion between the old ratio that worked and caused prosperity for 100 years and the new ratio we're at today. And my thesis is that in the big woods, we're going to be struggling with the liquidation of that 30 trillion. And with the suppressing effect that that will have on all the normal economic processes and ratios for a long time to come. Now, my last point is simply one question that I think is the heart of the matter. Either the pre-1980 world was the financial dark ages, and our financial forebears didn't know about the joys and wonders of debt, and that they dwelled in benighted ignorance and didn't realize that if they had just simply revved it up with debt, we could have had massive bounding prosperity decades and decades and decades sooner than we had it. We might have even had economic miracles like the internet occurring in 1950, not 1990. And it might have been invented by Senator Al Gore Sr. from Tennessee and not his son, as it happened. Now, that's one view of history. I don't think that would have happened, and I think it's wrong. The other view is that we've been on the wrong track since 1980, that we violated all the old-time religion, the ancient norms that the world learned over centuries and centuries were necessary for a healthy economy, and now we're in big trouble. We're in the soup. I'm not saying we're going to have a double dip. I'm saying we're going to have no dip. We're not going to get out of this for years and years because monetary policy is pushing on a string. Our fiscal policy is really calamitous, and that's what we're going to be dealing with, something totally different, totally new, and a lot more challenging than I think the consensus is expecting today.
Thank you, David. Chris?
It's really it's tough to follow that, yes. Number one.
Agreed.
Number two, it's hard to follow a clap after someone does. So we'll do our best here. I'm going to take a little bit of what David and Roger said, which is basically, let's put things into perspective about growth for a second. Double dip, no double dip, Great Recession, Depression, etc. We could potentially have a combination of both scenarios, which is a little bit more towards what Roger was saying, which is 2.5% growth from 2012 onward. And in my opinion, what's wrong with that? What's wrong with that is it's not as good as what most of us are all used to, where we had hyper job growth, where we had previous jobless recoveries, which are pointing to saying that there was a lot of jobs created in those jobless recoveries. But at the end of the day, the mechanism that's so most important in all this is going from the 1980s to where we are today, is what was the catalyst that drove us into what David described. There's many of them out there, but the chief catalyst was probably a disinflationary world, which actually led to the access to credit, and then the credit on top of credit, and then ultimately securitization. The securitization market and the packaging and financial innovation is what led bank balance sheets to grow and grow and grow. And now what we're going to have to go through is an extremely, extremely long workout. It's a repairing of the balance sheet of the rich world. Fortunately for all of us, and I didn't have a chance to listen to the last panel a lot, but fortunately for all of us, there's an area of the world that has a very clean balance sheet. And there's an area of the world that will kickstart growth and help us create new industries. And that area of the world is an area that went through a massive balance sheet cleansing in the 1990s when we were extending our balance sheet. So the rich world extended their balance sheet in the 1990s in the form of financial innovation, securitization, cheap access to credit, the whole bit. When we had flat yield curves, what did a bank have to do? A bank had to create a new profit stream. That gets into securitization and packaging and CDOs and investment banking and all these other things. On the flip side, the emerging markets were saving. They had a tremendous surplus. They were basically creating operating leverage, which was financing our financial leverage. We're going to have to go over the next 10, maybe longer than that, years to basically transition from a U.S. consumer-led growing world to an emerging market consumer-led growing world, which gets really back to the demographics that Roger talked about at the beginning. In the end, this is likely to create the same growth number that the world is used to, 5-6%. It's just dominated by a different catalyst.
So, thank you, Chris. Let's stick with you for a minute. Last year at the festival, you mentioned that we're in a sweet spot between recession and economic recovery. Do you still believe the recession has ended? And if so, what should have been done to accelerate recovery?
Well, let's take the first part. We're in the second sweet spot. Unfortunately, the second sweet spot is a little sour. And that basically is recovery to expansion. Recovery to expansion is longer than recession to recovery. So the length of recovery to expansion is allowing all of these dragons to enter into the equation, things like the deficit, things like fiscal policy, regulatory policy, the European financial distress, the elections in Brazil later this year, North Korea, South Korea, all these things are hitting at once in between recovery and expansion at a time when you hit a soft patch. That's why markets exhale, and that's why we had the June swoon. From a U.S. trust perspective, from an investor's perspective, we should be looking for more June swoons to take advantage and rebalance portfolios according to a rising profit cycle in the United States. And let's put this in perspective. We're not going back to 4.5%, 5% unemployment rate days or full employment at that level. 7.5%, 8% is a number we should get used to. Much of the jobs that were lost are going to be on the basis of retail sales tied to the U.S. consumer. But the bullwhip effect in manufacturing, industrial production, not being able to catch up to the forward-looking sales coming from the emerging markets is what's going to drive this profit cycle. And when you look at the S&P is in the sweet spot because the attribution of their earnings is tied more so to the global cycle, quite frankly, than they are tied to the U.S. consumer. Very different prospects going forward. But GDP is in that second phase, recovery to expansion. Unfortunately, we're probably going to grow between 2% and 3% for many, many years.
Roger, from your perspective, what's your take on the financial system recovery? You mentioned in your opening comments the small woods versus the big woods. We talked this morning about the global challenges that it presents to us. What's your comment?
Well, my perspective is that the financial markets are showing in different pockets that they clearly are healing. Now, let me be very explicit about what that might mean. For those who are, as my company does, has a huge investment in commercial real estate, we're discovering that market, which was completely frozen a year ago in crisis, et cetera, is now starting to turn around. Prices are not booming, but there's financing available there. For small businesses, the opposite is true. I think they're still having difficulty finding the capability to fund themselves. Large businesses have been able to go out to public markets and fund themselves quite easily. And certainly the U.S. government is continuing, for better or for worse, to fund itself at very, very low interest rates. We're seeing, as Chris indicates, that equity markets, while being very volatile, have some moments when individuals are piling in and then some moments when they're staying out. The things that started all of this, the freezing up in structured markets, that seems to be thawing as well. So we're starting to get, generally speaking, a healing of financial markets. That is just the first step towards the kind of expansion that Chris talked about. And I share his general view for many, many years we're going to have subprime growth. I'm not sure that we need to all get used to 7% unemployment rate for as far as the eye can see. We have gone through huge numbers of cycles in this economy. You'd be amazed at the number of times that we get back to approximately 4.5% unemployment relatively quickly. Not going to be dramatically fast, not a quick turnaround, but I don't think I'd buy into the 7% unemployment is the new norm for the next 15 years. I think that's not a particularly good model. Where I would like to join my two colleagues, though, is a point that Chris raised, which is, all right, so we're going through these ups and down cycles. David's got some good statistics about debt, and I share the general analysis. The question we all have to figure out is can we, in the context of getting to a more sustainable fiscal position in the U.S., deal with getting back to some reasonable growth? And it goes to, I think, a point that Chris made that I'd like to emphasize. What got us into the biggest amount of trouble was not a specific policy mistake, not a specific cut here or there. It was, I think, rather the fact that we were in, as Chris indicates, a deflationary economy because the Chinese were bringing in approximately 1 billion workers, manufacturing relatively high quality, relatively inexpensive goods, selling them to the U.S., and taking from us these government securities effectively, and then lending that money back to us. That kept very, very, very low interest rates for a very long time, led to what economists called a search for yield, which was people trying to get better returns, that then fueled housing boom and bust. Our biggest challenge is, can the U.S. and can the global economy grow in a much more balanced way so that China and the emerging markets have more domestic demand, require more of our exports, we become, frankly, more prudent in our savings postures, we consume less, and continue to have stable growth. That is the big question around at least a big part of the woods. Can the global economy rebalance itself so that we are not depending on everyone else's savings, we are not consuming everyone else's goods, and they are not perpetually funding this buildup of debt and deficit that David talked about. So that takes us away from your question, but I think gets us to really what I think this audience should be worried about, which is a version of the bigger woods. I'd add to that one other thing around the demographics, which is the retirement crisis that America faces. We now have 77 million Americans about to retire. Their 401ks have become 201ks and now have come back to being 301ks. No one has, or half the people working in America do not have employer-provided retirements. The defined benefit world is something that our parents knew and is now forgotten. So in addition to all the other debt issues that David wants to talk about, the whole issue of how we fund our retirements is a key issue. And our children are not going to do it. At least my son is certainly not going to do it. If you have a child who wants to fund my retirement, please. So while I can joke about it, I think this is another one of those key demographic bombs that really are on the horizon for us for the next 15 years.
David, you've been a vocal critic of the Fed as well as the policy decisions that contributed to the crisis. How well, in your view, did we react to the events that Roger has pointed out? And from that standpoint, what do you think, or what are your views or reactions to Roger's comments about how we begin to work or continue to work our way out of the woods?
Well, I think really we did exactly the wrong thing. In other words, by 2008, when the great heart attack on Wall Street came with Lehman, the body economic of the United States was comatose on the floor from 30 years of debt injection. So what did we do? We cranked up $1 trillion worth of stimulus on the fiscal side, and the Fed went berserk, printing money. And I say berserk guardedly. And what I mean by that is the quantitative easing and driving the interest rate to 10 basis points would have been laughed out of court by any economist, right, left, or center, pre-1970. And what we did in the 15 months after the events of October 08 was the Fed printed $1.6 trillion worth of new money out of thin air, buying all the treasury bonds in the world they could find, and more importantly, all the agency debt from Fannie and Freddie. And that $1.6 trillion in 15 months was more money than was created in the entire 220-year history of the United States, 2 times as much money. So why do I think that's wrong? Because I think that policy is what created the 30-year binge that I'm talking about. And if we want to get in the big woods, the global woods, I would say the global economy is a house of cards because what we did domestically didn't happen in a vacuum. It's exactly has a mirror image in what was created in China and so on. I think China's a house of cards. I think Brazil feeds the Chinese belly furnace with iron ore and the human belly with soybeans, and all of it is on a very rickety structure stemming from the massive trade imbalances that we've run and the breakdown after we closed the gold window in 1970. I know it makes me sound antediluvian, but so be it. When we closed the gold window, we basically created a system of open-ended debt creation with the US dollar that then got accommodated and created huge distortions abroad. Just take the numbers. From 40 years, from 1970 to today, we've had 2 trade surpluses, current account surpluses in 40 years. In the last 15 years, we've accumulated $6 trillion cumulative of current account deficits with the rest of the world. What did that do? It stoked a massive migration out of the rice paddies in China into the factories of the East Coast to create ultra-cheap goods that flowed to the United States that we couldn't afford because our income literally, really was falling. So we borrowed a bunch of money so that we could buy it, and in return, they took treasury bonds as payment. Now they're sitting on what is absolutely an economic freak of nature, $2.4 trillion of reserves, basically U.S. debt, on a $5 trillion economy. That's 50%. Now, I'll just give you one more fact. I know facts can say anything, but this one's powerful to me. Before we broke the world system, that is the last one we had that worked, Bretton Woods, When the United States was at its heyday, we had 20 billion of gold in 1960 and 500 billion of GDP. We were the center of the whole Bretton Woods system that worked, that was carefully created after World War II, and our reserves were 4% of our GDP. China isn't even the reserve currency of the world. In fact, their currency is illiquid and can't be traded, and they got reserves of 50%. That's crazy. That is a system that's malfunctioning, dysfunctional, and one of these days is going to break down in a huge way, and that's another factor on the radar screen of where we're going that needs to be very carefully considered over the next 5 or 10 years.
Chris, Roger, and then Chris.
Let me agree and disagree with David. And for your entertainment, I'll agree and disagree at a high decibel level so that you know I care. David's got the outcome basically right, which is that China's ended up with $2.5 trillion of reserves. Most of it is in US dollar denominated assets called treasury securities. No question of that. I think where he's got it wrong is this process did not, in my assessment, start because we had debt creation in the US. The process started in China because they wanted to modernize their economy. You're right. What they did was bring in millions of people off of the rice paddies into factories. They linked them into high-tech equipment, which they bought from the US and Germany and France and other places. You're absolutely right. They also are then consuming the worst soybeans and iron ore, and they're helping to drive the Brazilian economy, the Australian economy, et cetera. But it started with a very sensible domestic policy in China, which was following a sensible domestic policy in Japan and in Korea and other places. It was called export-led growth. They exported, they created cheap but high-quality manufactured goods. They sold them to the US at low prices, and absolutely right, we were living beyond our means. They therefore basically took our IOUs in the form of little dollar bills and started to store them up. And when they had all those dollar bills, there was the only thing left they could do with them, which was buy our treasury securities and continue the cycle. So I think David's right at the outcome. I don't think I would agree with you that it started because we were a debtor nation. The second place where I would disagree with David is his apparent love of the gold standard, because very few, he's smiling,
Modern people.
Very few, but I'm pleased to meet a person who was a gold standard guy in 2010. The reason but David is right about one very important point. When the world got off the gold standard because it had created the Great Depression in the 30s and moved to a flexible currency regime, many of these imbalances that we talked about fixed themselves automatically because currencies would go up and down against each other. The thing that has gone wrong here, and David put his finger on it, we need to pause on it, is that the Chinese have a currency that is not flexible, and so they ended up, instead of having the price of their exports go up, they were keeping their currency low, the price of their exports never went up, and that's how they ended up building up these reserves. So I would think, I agree with some of David's outcomes, all of his outcomes are factually true. I think the diagnosis of how we got there puts our debt in the wrong place, and it pushes us back to the gold standard as opposed to pushing us to a complete flexible currency regime, which is where I think you'd get the automatic fixing of the problem that we have today.
Chris, what is your take on this?
Yeah, to expand upon that, I would say that this, the dialogue that was just had there, basically is going to be the symptoms of the greatest shift we will all witness. And that greatest shift is unwinding exactly the 1980s through up until about 2008 or 2007, July 12th. When counterparty risk started to come out. Yeah, and that greatest shift really is a world that gets into better balance. So if you take Asia's surplus, you take their high savings rate, it's not going to take 1 or 2 years or 3 years or 4. It'll certainly take a decade or longer, but that savings rate will come down. Mm-hmm. They will expand their balance sheets. The consumerism will start to grow there. The demographics by default, the working age of 18 to 40 is going to start to spend. They'll build families. They'll buy appliances. They're already doing it, but there's not a lot of credit cards in the emerging markets. There's not a lot of home mortgage markets, et cetera. All of that is going to start to build up. That means the financial systems in those areas of the world are going to have to become more fluid. They're going to have to become more global. And that by default is going to transfer a lot of that buying power to our manufacturing prowess. So watch our manufacturing power start to grow in the United States. Our exports will mean more to GDP growth than they do today. Our domestic economy will mean less. So the consumer will spend less in the United States. They'll save a little bit more. That's called fiscal prudence. They're going to be forced to do it. It's fortunate. I'm going to take a little bit of different tact here than David. Surprise. But I think we're fortunate that the Fed did what they did, basically because a deflationary spiral will kill an economy for decades, for years. We know this is what happened in Japan. An inflationary impulse to an economy you can combat that better. So the fact that they expanded their balance sheet and they threw a lot of money at the problem basically is reflation combating deflation to ignite a little bit of inflation. And we haven't seen it yet, but the guess is that interest rates in the rich world will be somewhere around the goose egg, 0, for a very long period of time as reflation combats deflation. And if you look at what's going on over in Asia and in China and in Korea, Australia and some of the commodity markets, they're actually tightening policy right now. That's a clear indication that that's the growing parts of the world, and this is the depleting part of the world, and it's a transitional mechanism that's going to be a better balance in about 10 years.
So how do we, in this new or in this changing environment, fiscal prudence, I believe is what you said, how do we as investors navigate these markets? Does portfolio diversification, as we've understood it to this point, still make sense? And if it's changed, what do you think those changes will be reflected in?
Well, from a diversification standpoint, as a chief investment officer, it's probably going to sound a little weird saying this, but I think it's an overused word. The overused word diversification implies that you're spreading out your risks, so you're never going to be so you're going to be protected against even fat tails or big, large exogenous events. We've all seen that didn't happen. Correlations almost went to 1 in a lot of asset classes. I think what is most prudent going forward is, without question, what is called targeted deployment. At some point in time, at some day, week, month, quarter, or year, someplace in the world is attractive. Some investment in the world is attractive, whether it's the U.S. hard assets that the Chinese are now starting to look into, whether it's the Europeans who had a strong currency looking into our timber, or whether it's us looking into Southeast Asia, et cetera. At some point in time, there's value somewhere in a growing part of the world. Every cycle, whether there's a financial crisis, before the crisis, during, and after, has one dominant theme that absolutely, when we look back on it 10 years back, we always say, that was it. I knew it. I didn't invest around it. The first 3 years, I disregarded it. I said, it's not going to happen. The next 3 years, I said, it's getting more visible, it's getting more transparent, but I'm still not ready. In the last 3 years, that's when I started to invest, and that's when the sine curve starts to roll over. This time around, it's the same thing. That dominant theme is the great shift, the great rebalancing of world growth. It's about Southeast Asia and lowering their savings, increasing their spending. It's consumerism in domestic emerging markets. It's hard assets in the United States. It'll eventually be our commercial property. It'll eventually be land. It's timber. It's starting already. It's going to be shale plays in Pennsylvania. It's going to be the entire energy equation. We just need patience. It's not going to happen in 1 year or 2 or 3. It's going to happen over the course of a decade. Commodities around the world, led by areas like Brazil and Malaysia and Indonesia, those are the inputs to China's output. Roger talked about going from an export-driven economy to a domestic-led economy. They can't afford social unrest, so they will keep a clamp on inflation, and that's going to force more and more of those foreign exchange reserves to go into hard assets. So commodities, reflationary assets, domestic emerging markets that have consumer dynamics to them, and good old 1980s brand-recognized companies in the United States that are paying a good dividend with good free cash flow, that have most of their earnings coming from overseas, or at least a good portion of them coming from the emerging markets.
Roger?
Yeah, first, many of you, you've heard my introduction on the presidency of Tiaa. Most of you probably don't know what Tiaa is. We are the largest private provider of retirement in the world, and we manage about $435 billion of people's retirement money. I say that because while Chris and I think share many of the same diagnostics, the advice that I think we give average investors is totally different. Chris's advice, if I could paraphrase it, is think about the big theme and put all your chips on the theme.
Oh, no. I'll clarify that after. But
Maybe
no.
I overstated. Maybe I overstated. Chris's advice, let me then be more nuanced, is there are...
At a higher decibel.
At a higher decibel, right. There are a couple of themes that matter, and figure out 3 or 4 plays that let you take advantage of those themes. I think that's fair, okay? That's a nuanced statement. I would actually go back to where you started, Lloyd, which is we've been doing what we've done for 92 years through cycles. I actually think the best advice for the average investor is continued a version of diversification that reflects your risk tolerance. Mm-hmm. Chris may be right about these big themes, that the probability that the average investor is going to be able to pick and choose hard assets here, emerging market growth economy over there, well-known brand is here that are likely to go to exports, I'd worry a little bit about that. Most people, if they're wise, and this room is filled with wise people, I presume, should be investing for a long time horizon. You should be investing for 10 or 15 or 20 years. And I would argue in that circumstance, think about how much risk you can tolerate, set aside a general view for equities, fixed income, other alternatives, do a rebalancing once a year, and I would worry a little bit if we tried to chase themes, because Chris may well be right, but 2 years from now, Chris could be on the stage with me and David. David may be in a bunker because he's worried about what's going on.
I got my canned beans.
He got his canned beans. And the problem may be that the theme 2 years from now will be quite different. And then lo and behold, you're chasing that new theme. So I guess my advice is consistency, think about your own risk tolerance, take a long-term portfolio view, and think about the old theme of diversification, because I think that will get everybody through this much better than
Chris,
trying to
did you
chase
have a
a theme.
rebuttal?
Yeah, I do. Let me be crystal clear, as Tom Cruise said in a famous movie. Each and every investor, whether you are a private individual investor, you're a corporation, an institution, you have a risk policy in place. You have your own. That risk policy has changed dramatically in the last year and a half. It changed dramatically from late April to the end of June, when we had a 17% fall from the highs. From a U.S. trust perspective, we're discretionary fiduciary investment managers. So finding the decade-long theme for us is about deploying capital over time when large discrepancies in asset prices present themselves, and taking a very long, prudent approach to do that, and matching it directly to the risk policy of the actual individual. We have a ton of investors out there that are now 30%, 40% high cash allocated investors who were just at 10% in 2008, 80% equities, 10% fixed income. That has been turned dramatically upside down. Those risk policies are probably not going to change for quite a long period of time. But I think it's everyone's job to find out what that decade-long theme is and absolutely apply that to each individual investment policy of every individual that invests. And one way to do that, quite frankly, is in fixed income. If you're a fixed income only investor right now, you probably should not increase or go down in credit quality just to search for yield. You probably should look at some good sovereign bonds out there where you'll get some currency pickup. And it's not you, but from a discretionary investment management perspective, that's what we do. In moving forward, custom cash accounts, picking up the extra 40 or 50 basis points is going to mean a lot in a very tax-efficient way. And on the equity side, be very simple, very, very simple. Dividend-producing companies, even in the face of higher dividends, that have exposure to emerging markets overseas. If you're an equity investor, that's how you shift your policy to that. So I would say it's a combination of what Roger and I.
So I want to raise it up a little bit to sort of the average worker. Get to you.
100% gold.
So what does this mean to me as the average worker with an environment where we have these complex dynamics occurring, high unemployment? I'm looking at my own personal investment. What does that mean to me in terms of retirement, or even more broader, the labor force at large? And my second part of my question is, how do we, or should we, introduce more transparency into these complexities so that I, as an investor, your average worker, would be able to make decisions that are informed. David, what do you say to that?
Well, I would say two things. First, start saving like mad, because you're not going to make any return on any asset class, in my view, over the next few years. Secondly, if you want to get practical here and really want to make a lot of money and you got more of a risk appetite, short the reflation trade, because reflation ain't going to happen, inflation isn't going to happen, and there's a reason for it. So when I say short it, short BHP, short Rio Tinto, short Vale, short Brazil. The reason I say that is that this boom we had was not solid. It created a global house of cards, and it's going to come crashing down. So what we did in the United States simply echoed out around the world. It wasn't like 19th century England, where the merchants and the industrialists in the Midlands spent year after year erecting a great and mighty edifice of manufacturing and trade that created real prosperity. This thing was done on the fly by people in China who were reading the Little Red Book a few years previously. This was done, really, I'm telling you, this was done by a massive surge of global liquidity that caused investment to fly off the shelf in a haphazard, willy-nilly way that has created a very unstable system. And as a result of that, just think about what you see in China today. They had 100 million tons worth of steel production capacity in 1990. They have 700 million tons today. They were growing their steel capacity by 100 million ton a year, which is more than we had in the entire history of the United States, and the same is true in Europe and so forth. So this is one huge public works and infrastructure investment spree that went on way too fast, way too long, created huge excess capacity in the world for everything from copper to steel to housing to cement to oil and gas, frankly. And when we get to the break point, which I think we're near, that excess capacity is going to show up, prices are going to fall, wages are going to fall, standard of living are going to fall, stock prices are going to fall. So the best thing you can do is save your cash, hang on to it, and short the excess of this system that I think is in the process of unraveling. And that's why I opened by saying we're just getting started with the crisis. It's by no means over.
So let's look forward.
100% gold.
That's easy.
The Dodd-Frank legislation, as best I can tell, has really been focused on addressing some of the national things that we could do in the context of a global community. I think all of our panelists have pointed to how complex this truly is and our role in the global community. Roger, given that, what can we do, or what should we be doing in the global context to work more effectively so that these risks or these things that have contributed to the current crisis could at least be mitigated, or we could attack in a more proactive way?
Let me first echo one of the points David made without echoing his conclusion. I'm a strong believer that in the advice of save as much as you possibly can, even if you don't think the world is going to gradually erode in the way that David talked about, we have in this country a fundamental problem of too little savings. I'm not in the business of normally giving detailed advice, but for those who have mortgages, you may note that mortgage rates now are about as low as you've seen. So you might want to think about getting out of debt as best you can. So whatever happens with the global economy, David's advice that we all need to save more, including people in this room, is undoubtedly true. To answer your question, I think there are 2 or 3 things to recognize. One is it is going to be very difficult for any set of policies or procedures created by policymakers, regulators, et cetera, to ever avoid the ups and downs of financial markets. Get used to a certain amount of volatility, not as bad as we've had recently necessarily, but I think that's just part of the system. What can the regulators do in the world of Dodd-Frank and others? 3 things. One is insisting on more capital in the system, I think is quite important. How one goes about doing that internationally is a big challenge, but I think that's one. Secondly, we've learned the very important lesson that a number of us knew, but I would say was not built into the system, which is liquidity in financial institutions is key. And so the turn of the global regulatory environment towards making sure that institutions can keep funding themselves through crises is very important. The third is something that we've talked about for a long time. We haven't really managed to crack the nut on it, which is to really drive into the private sector the need to have first-rate risk management at financial services firms. Much of what happened, I believe, was because risk management in many of the largest, most sophisticated institutions sadly was taking a backseat to the need to take on risk in order to get quarterly increases in earnings per share. Now, again, my company is not a public company. We did not have to chase the earnings per share game. We avoided having any material amounts of subprime, and we've come through this thing with the largest amount of capital we've ever had. The reason I say it is not just to advertise my company, but to say that it actually is doable. Human beings can look into the face of financial institutions, look into markets, and make prudent decisions. Many financial institutions did not, but it is, I think, quite doable. So I think we've pushed those three things: sufficient capital in the banking system, strong focus on liquidity, and continuing incentives around great risk management. That at least gives us all a chance of mitigating, or having financial firms mitigate some of the volatility that I think is inherent in markets.
Chris, what's your perspective on what we could do going forward?
Well, certainly I would echo what Roger said, and I think as a broader envelope to that, it's clearly what's most important here is trust and confidence. When you go back to 2008, whether it was policy, whether it was balance sheets, whether it was the economy, there was various parts of the world that just disregarded the fact that we were going into an economic recession, not a meltdown. Meltdown was after the Lehman collapse, but actually an economic recession was really staring us in the face in late '07. And you think about one country which instituted a fiscal stimulus package before anybody else and saw it coming before anybody else, it was China, a $1 trillion stimulus package in '07. They see it, they lead the world as it relates to exports, so they see it. I say this because in '08, the reason why counterparty risk went out like this, there was zero trust and confidence that you were going to get your money back in whatever medium you were operating in. If you were lending money, you didn't know if you were getting it back. If you were very liquid and you actually had good assets, and there's a lot of companies out there that didn't make it that had good assets, were performing well, but somebody that had money with them had losses somewhere else, so they had to take it from here to fund other losses. And that is a connected system around the globe that needs higher liquidity ratios, higher capital, greater transparency, and certainly, without question, a greater trust and confidence in the people that you're dealing with all around the world. So the only way to do that is to not over-regulate. The way to do that is to enforce the regulation that's been in place. And we'll see what ends up happening. But the knee-jerk reaction is always to over-regulate, and that ends up pulling back credit, and I think that's what the biggest concern is going forward.
David?
I would say I'm all for trust and confidence, but the problem is the great institutions of this country are not worthy of trust and confidence. The Fed is not worthy of trust and confidence. When you have the kind of money printing spree that we've had over the last 2 or 3 years, just think about it. That is not confidence inspiring. The budget of the United States is a disgrace. We're going to have a $2 trillion deficit in the years ahead, and it's going to compound in numbers that are staggering. If you really go work through the numbers, I guess we're going to talk about it at a session this afternoon. Objectively, we're already at Greece. Not what they're reporting in the rearview mirror, but where we're going to be because of the drift, the political stalemate and paralysis. By 2015, we're going to be at 120% federal debt to GDP, and we're still going to have these huge deficits. Third, the institution of Wall Street. How can you have any trust in the institution of Wall Street when they make ridiculous arguments like they did during this last go-around of financial regulation, that somehow these massive supermarket banks actually are essential for the productivity and growth of Main Street America? It's just nonsense. Those are dangerous, destructive institutions. They ought to be broke up because they can't tell a straight story of the American people, and they're simply generating useless trading profits as a result of getting free money from the Fed and turning at hyper frequency rates every kind of tradable security known to man. So if you can't trust the Fed, you can't trust Washington, and you can't trust Wall Street, I don't know how we're going to solve this problem with trust and confidence.
Chris?
Yeah, I just have to say one point on that. I have to say 1,000 points on that, but since this is only a, I think it's important not to think in extremes all the time. I think ultimately extremes are visible. The middle is not. Usually the middle prevails. And then what I would say is when it looks at the industry, the financial industry, there are capital destroyers, there are capital creators. The capital destroyers are the ones that take too much risk, leverage up a balance sheet, and ultimately think they're going to get everything right. That's not all of Wall Street. That's not all the banks. That is some people within the industry that unfortunately extenuates itself to all people in the industry. There are some good companies out there that have very little to do with capital destruction that need to create credit for the small business owner, for the corporation, for the investor that needs funds to get access to help this economy move forward. The only way to do that is to have proper regulation, proper liquidity, trust and confidence in the system that we're not all at the extreme.
Thank you. Leading up to today's panel, Roger described himself as the squishy middle, and I didn't really believe it, but I think it's proven to be the case.
The way I described myself, to be honest, was the sensible middle.
Sensible.
Because I know my good friend David is sitting, as he is to my right, and Chris, who I don't know as well, has different views. But let me push in on this middle issue because I think it really is very important. The people in this room are thought leaders, and we're gathering here to sort of exchange ideas. We only have one central bank at a time. It may make mistakes, it has made mistakes, et cetera. I disagree with David firmly on their need to take policy action in 2008. I didn't say anything the first time around because Chris handled it quite nicely. Had the Fed not done it, we would have been in Japanese-style deflation and global depression today, and this conversation would have been quite different. They will continue to be the only central bank we have in the country, and I think it's quite important for us, while we can be critical of them, to have a fundamental sense that they're attempting to do the right thing, and broadly speaking, in the years since they were created in 1913, they have done basically the right thing. I do agree with David, though I would not have said it in quite as eloquent a phraseology as he did, that we are going to have to turn our national attention to the question of deficit and debt because it is unsustainable as it stands now. The good news around that is I believe the administration has shared that view as well. Now, will we be able to overcome some of the challenges that David talks about? Open to debate, but I would honestly go back to the trust and confidence issue. I think we can trust policymakers to know that the current debt to GDP ratio in the U.S. is not sustainable. And so I think it's really quite important to pick up Chris's point, and I wouldn't describe the middle in this case as being squishy. I would think, though, that there's a sensible middle ground that says we've got some big problems. David's highlighted many of them. It is time for us to get onto a national agenda that pushes those things forward. And the problem that I think we ultimately have is politicians who, understanding some of this, playing one against the other for relatively short-term gain, as opposed to what I think the national interest is, which is what we all share, which is to get over the D versus R discussion and get onto the U.S. discussion, which is keeping our deficits under control as we get forward. My applause is almost as big as David's applause.
Can I add one thing, though?
You can.
I agree with the need to be constructive and to get into the middle if we can. And I'll admit, I'm some kind of right-wing libertarian. But the first thing I would do on the fiscal issue, fundamental, which needs to be done, is I would let the Bush tax cuts expire in their entirety. Because that is one thing that Congress can do. By not acting, let those tax cuts expire, and we'll pick up $300 billion worth of revenue in, I would say, an equitable way. Half the people in this country don't pay income taxes anyway, so you would be protecting the poor. You would be protecting the people who are suffering the consequence of this great debt deflation that we're in. And that would start the ball rolling. Then maybe you could do something about means testing Social Security. So again, the upper income retirees make a sacrifice. So then maybe you could convince the American people that we got to get out of the imperialism business because we can't afford an $800 billion national security apparatus, you know, stumbling around in Afghanistan with no clue about what we're doing after 9 years, okay? But the problem with that is my starting point was let the Bush tax cuts expire, and the minute I say that, the Republican Party will get out the bloody shirt and wave it till the cows come home and scare the hell out of the American public, and the process of engagement on policy will never start. And I want to tell you that's where we are, and we'll be there in 2012, and maybe we'll have a defining election or maybe we won't. But until then, because they're unwilling to take the first step, let those tax cuts expire that we didn't earn, and that all those Republicans waving the bloody shirt never cut one dime of spending in 30 years. The referendum is over. The game is over. They're faking. We have to pay more taxes in this country or we're going to go broke. It's that simple.
On that point, I'd like to open it up to the floor to ask questions. Please, please use the microphones, keeping your comments to a minimum, but having a direct question. Yes, sir.
Ron Sims, question for Mr. Stockton. Given your comments, where are you investing your money?
You know, I think I'm investing my money exactly where I told you. One, I think there's nothing wrong with cash because in a world in which prices are falling, and I think they will be, we're almost to zero now, and they're going to go lower, cash will have more value, and that seems like a pittance, but compared to risking losing a lot of money again in the next collapse of risk assets, so-called stocks and ETFs and so forth, I think you'll be better off. Secondly, I am short the reflation trade and a lot of other, you know, bubble recovery, which is temporary. It's not going to last, and I think I'll do okay there as well. But we're in a different world, and so the people from Wall Street who come and tell you, let's paint by the numbers, you know, we're 11 months into a recovery, and here's where we are on this point and that fact and this point compared to 1982 and compared to it's all 1991. It's all irrelevant. Those were cycles that were overcome by another injection of debt, and we lived for another day and had another cycle. I say we're at the end of the debt super cycle, and what is going to go forward in terms of investment and where you can get a return and where your risks really are is going to be fundamentally different in the next 10 years than it was in the last 30 years. And that's the starting point for where you ought to put your money.
Yes, sir.
John Debs, Palo Alto. I think the panel agrees that we need more savings and investment and less consumption. But, you know, our tax code isn't written that way. So my big idea, I'd like your comments are, increase the national security tax, known as the gasoline tax, put in a carbon tax, put in a VAT. You can raise the marginal rates, but hold down all tax rates on investment, because this country, if it's going to go forward and create new jobs, has to go from consumption to investment. I'm interested in your answers to that.
I guess I'd broadly agree with the hypothesis that we've got to go from consumption to investment. And I agree with your general theory that we need to have policies that incent that. The question of the VAT, as you well know, or consumption tax, there are a lot of details how you avoid making that regressive, but I have no general objection to the thought, as long as you can avoid making it regressive. I think David's absolutely right, and you are pushing his point as well. We've got to figure out a way out of Social Security's difficulties, and the reality is some of us paying more for that, the way David talked about it, the way you're suggesting, doesn't strike me as being unreasonable. It may not be politically palatable, but it doesn't strike me as being unreasonable. So broadly speaking, I think your general direction makes an awful lot of sense.
Yeah, but there's not one vote in Congress for what I've just suggested. And you know, the leadership in this country is going to have to step up and start talking about these things, not scaring people to death, but saying, hey, this is the way forward. Right?
I agree with you completely. That's why I talked about the difference in no longer being D's and R's, and I think David would agree. At some point, we all have to step up and say, we've got to save more, we've got to consume less, and yes, in order to get out of this deficit issue, taxes on wealthy people, sadly or not, are going to have to go up. There's no magic about how we do that other than that.
Chris, you want to jump in?
Yeah, I think the statement "there's no magic" is a one we're going to talk about for many years. And to your point, to your question, really, let's break it down simply and let's get logical about this. If consumption was the issue as it relates to access to cheap credit, extending ourselves, keeping up with the Joneses, there should be a transfer of power from consumption-based expenses into capital investment. If we raise taxes on capital investment, if we raise taxes that will curtail any small business job growth, we will not grow at 2%, we will grow at 0%. It's as simple as that. So the fundamental question here is, what do we do cyclically in the next 2 years to get us to full recovery and then into a potential next expansion? And what do we need to do secularly in this country to fix the long-term entitlements? Two very different questions. Cyclically, we need a very proactive Fed that does reflate at all costs. Reflating doesn't mean inflating. So reflating, we need that. Mortgage rates are at 50-year lows or record lows, 4.5% for a regular 30-year. For those who can refinance, that's a good thing. That's going to change the fiscal power in this country over the course of the next few years. But what I would simply say is this: if you're going to raise dividend taxes, if you're going to raise capital gains taxes, you disincentivize what we so sorely need, which is investment. And the fact that that is still being talked about right now is a fundamental misconception with policy change. And go back to 1937, major policy era kicked us into a depression for the next few years. We can't afford that to happen. So if you had to think about cyclical versus secular, I would say raise taxes just a little bit to get people to understand that we need to change the fiscal balance, but actually don't go way too far, one extreme versus the other. And secularly, the only way out, Roger's absolutely right, there's no magic. It's a structural change. You're going to see retirement age kicked up at some point in time, a few years. You're going to see lower allotment into Social Security or from Social Security into those who retire. And you're going to have to see a change from defined benefit plans into defined contributions across the board.
I would like to comment, if I could move to the left wing now. I agree that we need to have a value-added tax. But I want to tell you, I don't think you're going to put a tax on the great wage-earning population of the United States that's in very serious state of worry and insecurity right now because of the weakness of this economy, if you keep talking about how we have to have incentives for investment. Because I thought it was pitiful to see all the great leaders of my old industry, the private equity world, go down to Washington and pathetically lobby the Congress to retain their 15% tax on the carried interest when everybody else in this country is going to be paying 30 or 40. Now, here's the point. I was all for the capital gains revolution when I was in Congress. Bill Steiger was a friend of mine. I voted for the Steiger reduction. That's when inflation was 10%, and therefore gains earned over 4 or 5 years shouldn't have been taxed at ordinary rates. We're at zero inflation. There is no difference between gains income and earned income, and they ought to have the same rate. It is not going to kill the economy to raise the capital gains tax as part of a package to get revenue into the Treasury coffers out of the great masses of the American working population. We need to update our thinking based on the realities of the world we're in and not the ideological debates of yesteryear, which I think this whole thing about investment incentives and retaining a low capital gains rate is all about. That's yesterday's business. It's not tomorrow's solution.
Yes, sir.
My name is Richard Palin. I have two unrelated questions. First, is Japan of the 1980s a metaphor for the United States and maybe the rest of the world? And if it is, what kind of investments worked in Japan during that period? And second, if without question the single most important reason for the crash that we all endured was over-leverage of financial institutions to the tune of 30 or 40%, why is it that in over 2,000 pages of legislation, there's nothing in there regulating financial institution capital ratios other than leaving it to the foreigners to come up with it over the next several years?
Thank you.
I'll take the first one. Again, I'm the optimist on the panel, so I don't think that the United States capital market system can allow a Japanese debt deflationary spiral for as long as Japan has been under, number one. A lot of reasons for that. Most of it has to do with the cross-share holdings of the Japanese companies when this all started, and the inaction of the Japanese central bank for years and years and years before quantitative easing came in. And then multiple increases in sales tax in 1994, I think again in 98, that really turned the economy upside down once it started to get going. So that's it from an economic perspective. From an investment perspective, Japanese small caps did well, extremely volatile though. So getting back to what Roger said before, not for everybody. That's for sure. But the most important thing about Japan is Japanese government bonds, number one. Number one performer. Number two were the exporters in the equity market because they kept a cheap yen to try to ignite inflation, and that allowed the Japanese exporters to do well. Sony, some companies like that, et cetera. So if you think about the United States, if we're going to change the balance of the world, you're going to want to own companies in the United States that have good balance sheets already, don't need to access the capital markets, have exposure revenues overseas, basically, with products that the person who has pent-up demand wants.
Roger, you want to take the regulating the capital ratios?
Yeah, you're right. There's a bill that's 2,000 some pages. It hits some things that were not relevant to the crisis. I think I disagree with you a little bit. It does put into place a requirement for a leverage ratio broadly and defines that. The reason I don't think you're right to say it leads it to the international community or to foreigners to determine what it is. It reflects the fact that financial services is now a global industry. A leverage ratio in the U.S. that's different from what is imposed in Europe creates some imbalances. So I think it's very important to try to have an international agreement around this thing. I will, though, buy one of your points, which is as soon as you say that, that is back into a big negotiation and it's back and forth and it takes too long to put it in place. That's why I put a lot of emphasis on driving, independently of all of that, an expectation of much better risk management and being driven by regulators demanding improvements on Wall Street. So I would caution you not to be quite as cynical about it, but your point that there's a lot in there that doesn't hit the crisis, absolutely true, but there is a focus in on leverage in the bill, as I recall.
The timekeeper is flashing me that we're approaching the end, so we have time for just one more question, then we're going to wrap up. Sir.
Bill Obendorf, San Francisco. John Gardner wrote a wonderful book entitled On Leadership, and at the beginning of that book, he stated that he had no doubt that we'd be able to identify our problems, but the real question was whether we'd have the resolve to deal with them. And it would seem that we are beginning a serious national debate on deficit reduction, but whether we'll have the resolve to deal with that is another matter in any reasonable time. So my question is, if we're going to continue to deficit spend, what should you do investing-wise when you think of cash, David? If we're going to continue to deficit spend and print all that paper, cash ultimately becomes worth less, and ultimately there's more of it, and the Chinese or whoever are going to they're going to require us to pay higher rates on that. So if you're sitting there holding cash, isn't that problematic in that sort of world?
Yeah, I think that is a fair comment, but let me go to answer it by go to the question about Japan. I think we are Japan in the 1980s. I think Japan tried super Keynesian stimulus for 15 years, and over that 15 years they buried the archipelago in cement with bridges and roads to nowhere, and they ended up with 200% debt to GDP off the charts compared to everybody. Now, if I would think back on that, and you asked me what should the Japanese guy have done in 1989 when this started, he should have bought gold at the exchange rate, 200 yen to the dollar. He would be rich and retired today. So maybe that's the right answer for the next 10 or 20 years, because I think all currencies are eventually going to be repudiated and depreciated. I was talking about cash in the shorter run. If you want an appreciated asset in the longer run, gold's the only one that I can think of. That is likely given the scenario I see.
I'll stick with my aggregates investments.
I'd like to thank the audience for their questions. Before we leave, I want to ask the panelists for if there's one sort of takeaway message, what would that be for today, given are we out of the woods yet? Start with you, Chris.
Are we out of the woods? Absolutely, from a financial crisis, counterparty, non-trust perspective situation. As it relates to one thing to think about over the next decade and to invest around it, whether you're an all-cash holder, an all-fixed income holder, a balanced account holder, a gold holder, Mr. Stockman, whoever you are, think about one thing. Every decade is dominated by one theme. That one theme is usually discounted the first few years. It's embraced by few in the middle 3 years, and it is embraced by mostly everybody in the last few years. Unfortunately, that's when things start to roll over. This time around, the catalyst to world economic balancing is the unraveling of what David talked about over the 1980s or late 70s all the way till now. And we need to invest around it, whether you're in fixed income, in cash, a balanced investor, an all-equity investor, whoever you are, and whatever wealth segment you are. When there's an absence of yield in the world, don't chase yield through quality. Go towards yield through high quality. So don't chase yield through low quality, go through low quality. Gold doesn't pay you to wait.
Thank you. Roger?
3 points for me. Are we out of the woods? Yes, in terms of avoiding the Japanese scenario. No, in the sense that we still have a long way to go to get back to full employment and other things. So a slow, uneven recovery. Get used to that. Second point, the broader issue that we talked about are the 3 Ds: deficit, debt, and demographics. You as thought leaders in the country have to start to do what one of you suggested, be part of the leadership that gets us out of the back and forth of ping pong to the place of, all right, we really have to take this very seriously, including things such as tax rates and others that David has put his finger on. The third thing is, and this sounds very squishy middle, I do believe that we've got the wherewithal to do this. The answers to all of this are already written down. It's all about execution. For those of us who have, I do, kids who are 18 and 15, they are going to clearly live in a much more challenging world. But if we don't do something, their world will be not just challenging, but much worse than the world that we've inherited. So it's not for us that we have to do this. It's really actually for the next generation, obviously.
Thank you. David?
Well, it's always good to end on a hopeful note, and I would like to, but I have to follow the logic of my views. So I think we're in the woods, we're getting in deeper. It might be good to rent a cabin, probably stock up on some canned beans and water, and wait for the thing to blow. That's all I can tell you.
Thank you. Thank you very much. All right, thank you very much. I'm headed out.